Have you ever wondered why Netflix shares took such a hit in 2026? Investors were shocked as stock prices fell faster than expected. Today, we're breaking down the biggest mistakes people made and what you can learn to avoid losing money in the future. Every decision counts in the fast-moving stock market. Knowing the key reasons behind drops gives you an edge. Like, subscribe, and comment if you want to invest smarter. Let's dive into the lessons from Netflix's turbulent year. Number 10. Declining subscriber growth. One of the main reasons Netflix shares dropped in 2026 was slowing subscriber growth. New sign-ups failed to meet analyst expectations, while older users canceled subscriptions due to rising costs. International markets also showed weaker adoption than projected. This stagnation signaled to investors that Netflix might struggle to maintain revenue growth. Markets reacted immediately, punishing the stock. Without strong user growth, future earnings appeared uncertain. This is a reminder that user metrics drive valuation in streaming businesses. Keeping an eye on subscriber trends is crucial for investors. Number 9. Increased competition. The streaming landscape became crowded in 2026, with Disney+, HBO Max, Amazon Prime, and emerging regional platforms aggressively expanding. Netflix lost exclusive content battles, and original shows faced stiff competition. Viewers spread their attention across multiple platforms, reducing engagement per service. Investors feared market share erosion and slower growth. This uncertainty caused a rapid drop in stock confidence. Even a well-known brand like Netflix cannot escape competitive pressures. Monitoring the competitive landscape is key before buying shares. Ignoring rivals can be one of the costliest investor mistakes. Number 8. Rising content costs. Content creation costs for Netflix skyrocketed, with high-budget originals requiring massive investments. Licensing fees for popular shows and movies increased, squeezing profit margins. Investors worried that revenue would not grow fast enough to cover these costs. The spending pressure amplified concerns about profitability. Reports of delayed returns from certain series added to the anxiety. Rising costs combined with stagnant subscriber growth created a perfect storm for share decline. Financial discipline in content spending became a major focus. Evaluating cost efficiency is essential before investing in media companies. Number 7. Missed revenue targets. Netflix repeatedly missed quarterly revenue targets in 2026, signaling weak performance to investors. Earnings reports highlighted slower than expected growth in key markets. Forecasts for the coming quarters were revised downward, further eroding confidence. The stock market reacted immediately, showing how sensitive share prices are to revenue gaps. Analysts emphasized that even slight underperformance could trigger large sell-offs. Missing targets repeatedly damages credibility with shareholders. Transparency and communication are critical in maintaining investor trust. This mistake illustrates the importance of monitoring earnings history carefully. Number 6. Over-reliance on original content. Netflix relied heavily on original programming to attract and retain subscribers. While originals can be profitable, over-reliance made growth unpredictable. Some high-budget releases underperformed, impacting revenue projections. Failure to balance licensed content and originals reduced flexibility. Investors became wary of volatility in returns. Markets dislike uncertainty, and profits swinging wildly increased risk perception. Diversification in content strategy is essential for stability. Learning from this helps investors avoid overexposed stocks in uncertain sectors. Number 5. Price hikes and user backlash. Netflix implemented multiple subscription price hikes in 2026 to cover costs. However, users reacted negatively, with many downgrading plans or canceling entirely. Social media amplified dissatisfaction, signaling potential long-term retention problems. Investors feared that higher churn would undermine revenue growth. Balancing pricing strategy and customer satisfaction is critical. Sudden increases can backfire, affecting both users and stock performance. This mistake underlines how operational decisions directly impact investor confidence. Understanding customer sensitivity helps predict market reactions. Number 4. Weak international expansion. International markets underperformed, particularly in regions where Netflix expected rapid growth. Cultural preferences, local competitors, and regulatory challenges slowed adoption. Forecasts for global subscriber numbers had to be revised downward. Investors reacted to missed expectations with caution. Even a global brand can face unpredictable challenges abroad. Expansion plans must account for local conditions. Analyzing international growth potential is key for making informed investment choices. Ignoring these factors can lead to overestimating future revenue. Number 3. Investor overconfidence. Many investors assumed Netflix's dominance in streaming would continue indefinitely. They ignored warning signs of rising competition and slowing growth. Overconfidence led to heavy stock positions and poor risk management. When the shares dropped, losses were amplified. Failing to consider external risks is a classic mistake. Prudent investing requires skepticism, research, and diversification. Understanding market dynamics prevents being blindsided by sudden changes. Overconfidence can be costly, even with a popular stock. Number 2. Poor risk management. Investors failed to implement stop-loss strategies or diversify holdings adequately. When Netflix shares fell, portfolios suffered heavy losses. Relying too much on a single sector increased vulnerability. Proper risk management could have reduced exposure and limited damage. Markets are unpredictable, and volatility is normal in media stocks. Diversification and hedging are critical tools for all investors. Learning from mistakes prevents repeating costly errors. A disciplined approach separates long-term winners from reactive traders. Number 1. Ignoring market signals. The most common mistake was ignoring clear warning signs from the market. Declining engagement, slower subscriber growth, rising costs, and increased competition were all visible months before major drops. Investors who failed to act early suffered the largest losses. Listening to market trends and analyzing data is essential for timely decisions. Ignoring signals leads to panic selling and missed opportunities. Proactive observation allows investors to make informed, calculated moves. Understanding the warning signs can protect both money and confidence. Investing is never without risk, but studying mistakes helps avoid major losses. Netflix shares dropped in 2026 due to predictable factors that could have been mitigated. Learning from these lessons strengthens your ability to make smarter choices. Start tracking metrics, managing risk, and diversifying your portfolio today. Don't forget to like, subscribe, and comment to stay updated on investment insights. Your financial future depends on staying informed and making thoughtful moves.